Okay, it should be. Yep, okay, it's live now. Hi, everyone. Welcome back to our Teen Financial Education Series videos. Colleen is here again with me from the Michigan Schools and Government Credit Union, and she'll be leading us once again. This week, we're talking about credit cards.
All right, good evening. Thank you for having me. Again, my name is Colleen Godfrey from Michigan Schools and Government Credit Union. On the next slide. Here we go. So what is credit? Before we even specifically get into credit cards, what is credit? Credit is really the ability to obtain goods or services before payment. You think of credit as something extra, but really it's buy now, pay later. The ability to have something now, whether it's have the car now that you don't want to take the time to save up for, or have the education now that you don't have time to save all the way up for, or even the sandwich right now that you had to borrow, $5 to have. It's having something now upon the trust that you'll pay for it later. So there's lots of examples of types of credit. A credit card is just one example of credit. An auto loan, a home loan, motorcycle loan, they're all different examples of borrowing so I can get something now upon the paying for it later. So looking specifically at credit cards can be somewhat of a taboo topic. Usually people have a strong opinion of, oh, they're terrible, don't stay away from them, never get a credit card, or I love my credit card, absolutely love them. Which one is more accurate? Are they a tool or a trap? Well, they can be both. I mean, really, they're either. I mean, look at your car. Your car is a great thing. Gets you to work every day, gets you around, keeps you warm, keeps you cool, keeps the rain out, does all kinds of great stuff. But if you're not trained how to drive the car correctly or use it properly, you're probably going to go too fast, not going to follow, the rules. You're going to get into an accident. You're going to hurt people. It's very dangerous. So in the same way, a credit card can be very detrimental, but not if you know what you're doing, not if you plan ahead, you and make informed choices rather than pressured choices. So part of tonight is, what do I need to know about a credit card before I even get one, right? You'll be offered plenty of credit cards. There'll be a time when you'll receive lots and lots of offers in the mail. You'll think you're so popular. You're pre-approved because your name is on a list of a demographic of, I hate to say, well, younger people with less experience. They don't ask a lot of questions. They don't read the fine print. They're pretty easy to get to say yes to anything. You send them something flashy and tell them they can put their picture on it. Any of these things can get you to say, yeah, sure, I'll take that credit card. Why not? Well, as a comparison shopper, as an informed consumer, what do you need to know about it? What do you need to look at so you can even evaluate whether this is the card for you? Look at the credit limit. The credit limit is literally that, the limit, the maximum that you can spend on a card. A credit card is not just an unlimited, golden purse that you can just keep spending. There is a maximum. Your first credit card will likely be a $500 maximum, a $500 monthly limit. MSGCU, we also have $300 limit cards. If you want to start even smaller, it's just a matter of getting used to the concept of having a card before you need to raise it to $1,000, $2,000, $5,000 limit. If you can't pay back a $5,000 right now, you don't need a $5,000 limit. The minimum payment is exactly what it sounds like. It's the smallest amount you can pay towards the total bill without any sort of penalty. When you get a loan for a car and they send you a bill, they don't ask you to pay for the entire car. They say, please pay this month's portion. And then you get a bill the next month and you pay that month's portion. It's a little different. But credit cards are the same way in that they offer the luxury of time. You know, if you only have a little bit, you only have to give us a little bit. You don't have to pay off the whole thing. And the minimum payment is a percentage of the total that you owe. And it's gotten lower and lower and lower. It used to be almost 50% when credit cards first came out, you know, in the 1950s, 60s. And now it's down to 2%, 2 to 3%. Meaning I'm only going to ask for 2% of what you owe me. Sounds great, but we're gonna see where that takes us. Well, the APR, you probably heard APR on commercials, annual percentage rate. Annual percentage rate is fancy terms for the interest. It's the interest rate that you have to pay on your remaining balances. If you spend $500 in January, but you only send them $10, well, then you have $490 that's going to be charged interest because you used that luxury of time saying, I'm just going to let this sit. I'm not going to pay yet. So do we want a large number or a small number? A small number, right? Small. We do not want to pay more. We want to pay the least. So we want a low number for an APR, and not just low numbers, but we want to look whether it is a fixed rate or a variable rate. And that's very important. And it's not going to be right out there and highlighted and underlined. You know, you're going to have to look. A fixed rate, again, just like it sounds like, it's fixed in position, fixed in place, not going to change. You sign up for the credit card today at 19%, it's going to stay 19% as long as you have this card, even in 20 years. A variable rate literally means it can vary, that you're acknowledging that this number can change. And you don't get to change it. The credit card company gets to change it. And they change it depending on the market, depending on inflation, depending on your behavior. You know, if you've made late payments or missed payments or tried to spend over the limit, your punishment could be a higher interest rate. So certainly for your first couple cards, I highly say get a fixed rate. Not all variable rates are bad. Not all situations with a variable rate card are bad, but at least in the beginning, you want to know what you're in for. You don't want any surprises, and you want as much control over it yourself as possible. So you want to look for a low fixed rate. So this chart is showing us examples of payment. So let's say we got a brand new card this year, and it has a $2,000 limit. We got it brand new this year. I actually spent all $2,000. It was a car repair. I had to be done. I decided to put it on the credit card. That's why I got the credit card. Now, we look at the interest rate here, 19.8%. That's high. That's high. That's probably around what you will be offered as a, in the younger demographic. You will be offered in the 20s, 25, 27, because again, are you going to ask questions? Are you going to notice? Do you know if 27 is a high number or not? I could probably convince you that it's a low number and get you to sign up. So this person, this example, has a pretty typical 19.8% APR. They get their bill at the end of January and saying, you spent $2,000, but can you please send us $40 as the minimum payment? Oh, you feel so much better. You're like, $40, I can afford $40. Oh, I was worried you were going to, make me pay like a lot of money. So by the end of January, you've paid $40 and your balance has decreased $40. All right, we're on the right track. As time goes on, months go by, you keep sending that payment in. You're paying it on time. You're paying it early. You're getting real proud of yourself. You're really getting this whole credit card thing down. then one day you sit and do the math and you look and you say, wow, in 5 months, I paid $200, but my balance has only gone down $68. I've just thrown away $150 basically. So yes, technically you have been doing everything that you're allowed, but if you notice 19.8% times the remaining balance, you are getting charged a hefty fee each month for interest. So you're only paying like $7 a month. What if you didn't notice? What if you were just proud of yourself for making those on-time payments and making sure you pay that $40 every month? What if you were to pay the entire balance off, the whole $2,000? You didn't put anything else, no other purchases on the card. You closed it after you made this purchase. If you had that 19.8% APR, that would be 9 years to pay it off. I mean, think of what you were doing 9 years ago. That was a lifetime ago. You probably don't even have the same car. Do you even live in the same place? But even more important than the fact that it takes such a long time is look at this interest, $2,261 extra. That's extra on top of the $2,000 that you paid in the first place. So out the door, by the time you made your last payment, you paid over $4,000. Well, good thing you attended this workshop tonight, and you comparison shopped and you did your research, and you found a card with a much lower APR. You found the MSGCU Classic Visa with a 12.75 fixed rate. And you do the same thing. You still make your $40 a month payment. Wow, that's great. I mean, 6 years is not great, but wow, look at the interest. I mean, it cut it in more than half. And I'm doing literally exactly the same thing, just paying $40 a month. And look at this huge difference here. So it's really, really worth your time to find a lower interest rate. But Josh, I'll ask you here, if this was your situation and you saw the difference between 2,200 and 868, would you be satisfied with 868 as a pretty reasonable amount of interest to pay?
Yeah, it'd be a lot better than the 2,261.
It would be a lot better, but on a $2,000 bill, paying an additional, it's still a lot. That still seems like a lot. So maybe this is where everyone says people get trapped and they're just never going to get out of debt because I don't understand. It's not getting any cheaper. Well, pay more than the minimum. It seems simple. It might seem obvious, but it's not. The credit card companies, are not necessarily going to encourage you to pay more because the less you pay, the more they make. Look at this difference. I love showing the slide. Exact same thing, same 2 cards, same $2,000, but in $100 instead of $40. $60 more a month. It's like one work shift, like one Saturday afternoon you have to do. And you're paying $400, $200. Yeah. The most important thing here is this car repair was exactly the same for all 4 cars. It was exactly the same repair shop. It was exactly the same work. That was the same. But one person paid over $4,000 and one person ended up paying just $260 or $2,260. I'm sorry, I cut you off. What were you going to say?
I said, yes, that is much better. And
that is significantly better. Yes. And again, that's only paying $100. By all means, pay more than that. Pay $150, pay $100 this month and $150 next month and $200 the month after. Pay as much as you can. This is just to illustrate how in your head it might sound like a good idea to pay the minimum because I want to spend the least. I want to hold on to as much money as I can. But it's showing you that is not the right way. Paying the most upfront, the getting rid of your debt, not paying that interest is huge. And again, we didn't buy anything else. Imagine if even over these 2 years, you were continuing to use the card. Is that balance really ever even going down? So how do we know if a credit card's right for us? Well, they're not all created equal, right? We need to have an idea of why are we even interested? Am I interested in a credit card just because I got it in the mail? Or is it because my friends have been talking about it and they're starting to get one? Is it because I'm moving off to school, in the northern part of Michigan next year, and I'm not going to be able to be in constant contact with my parents anymore, and they might not be able to deposit money into my account. So I want to have this safety net of a credit card. Look for what you have in mind. They're not all the same. You want a low interest rate. You want a low limit. You want a fixed rate. While it's tempting to just pay that minimum monthly balance, pay more. Always pay more. And I mean always pay more. Literally, you never want to pay that minimum balance. If you have that, you're asking to pay $40 and you're thinking in your head, oh my God, I don't have enough. I'm really, really strapped this month. I can only pay $45. Great, pay $45. Not great, but pay $43. Just always, even if you're thinking I can really only make this minimum payment, always pay something more, right? Just some sort of contribution. Any of your bills that you have, your car payments, your student loan, if the bill is $200.54, just send them $201. That 50 cents or so, it's gonna start making a difference. Always pay more. Once you pay that minimum, it's very easy to become a habit. I did it last time. It wasn't really a big deal. No, that is what you want to avoid. You will pay no interest if you pay off the total balance each month. That is the big trick. That is when everyone's like, oh, stay away from credit cards. They're terrible. You'll be in debt. Well, yeah, that's possible. But if you literally play your cards right, you can have a credit card for decades and never pay a cent of interest. It's the agreement. The agreement is you can purchase items, receive those items, and at the end of the month, we'll ask for payment. And as long as you agree to pay us, we'll just go back and forth, and this is a nice gentleman's agreement, and everyone's happy. When you say, I can't pay you all of that, I can only pay you some of that, now it starts to become more expensive. Now, credit cards can be your safety net. As I mentioned, if you're living, up north and it's a 6-hour drive in the snow and you didn't expect to have to stop for gas and you don't have any cash on you, that's what that credit card is there for, to make sure you can get that gas. If that car stalls and you need to get a tow truck in the middle of nowhere, that's what that credit card is for. If you are in college and you end up having to switch classes or drop one class and pick up a different class, and now that class has a $300 textbook I need to go buy within the next couple days, I don't get paid till next week, that is what the credit card is for, right? It's not your debit card. It's not your breakfast, lunch, and clothes and gum and toilet paper. That's your debit card. That's your checking account. That's your money. That's your budget, right? The credit card is intended for when something unexpected or unusual or emergency. Let's say the refrigerator goes out and you don't have enough to purchase an entire refrigerator, but you can make installment payments. Or, if the furnace breaks and it's the wintertime, you've got to replace that furnace. So you might have to put something on a credit card. You might have to make partial payments. But again, you don't have to pay the same thing every month. That example was, so mathematically you could see if it was this amount every month, it would end up like this. But you can pay more and more and more some months, less other months. You can pay off you're balancing full 10 months out of the year and not 2 months. Again, that is all the individual person. And that's how credit cards can either really save you in an emergency, really get you out of a jam, you know, really allow you the opportunity for things that you may not otherwise. If there's a terrible, you know, a death in the family and there's no way you can get across the country unless you put that plane ticket, you know, on the credit card, or, you know, my contact lens got ripped and there's no way I can go back to medical school without another contact lens. I mean, there's times where you may have to borrow from yourself to keep going, but you're borrowing from yourself, right? It's costing you money. Make sure you comparison shop. Make sure you understand all the terms and conditions. Make sure you ask every question you can think of. I really try to reiterate, don't feel bad about asking questions. It doesn't come across as, you know, uneducated. It comes across as smart, that you care, that you're invested, that you want to know, that you're going to keep asking until you understand. No, that doesn't make sense yet. Can you go through that again? Yeah, but I still don't get where that fee comes from. No, and where does that fee come from? Keep asking questions. If they can't answer it, if it doesn't make sense, you walk away, step away. Anyone who is trying to do a financial transaction with you, a loan, you know, they should have both of your best interests at heart, right? What's the interest rate? Is it going to change? You know, what are the late fees? Is the late fee assessed at midnight if I don't pay on the day it's due and it's $20? Or is it $50, but I have 5 extra days, you know, grace period? These are just questions that they're not going to necessarily point out unless you ask. So before you sign on the dotted line for any credit card, or really, you know, even if it's a retail card, like a Kohl's card, or, you know, a Macy's card, understand what you're signing. Understand if it's a variable rate, it could really go up and you have no control over that. Know how to interpret your statement. It showed an example of the statement here. And if you get it and you're still kind of not sure, take it to your credit union, take it to your bank, online chat, call the credit card company. Luckily, it should be relatively self-explanatory because there have been new laws within the last, you know, since Obama's presidency about truth in lending and, you know, the Fair Credit Card Act, and having to put specific information such as if you pay the minimum, it's actually going to cost you this much, has to be printed on your statement where you can see it, you know. So there is more visible, clearer information than there used to be, but that doesn't mean it's all going to make sense. So make sure you look at the purchases. Do these all make sense? So I didn't go to any drugstore. If I didn't go to any drugstore and I didn't spend that $17, I better get on the phone with my credit card company right now and say, hey, you know, this is fraudulent purchase, or I think it's a fraudulent purchase. Can you tell me more about this? Maybe drugstore is the name of a fancy boutique that you went to and you didn't realize that was the name. And you say, oh, okay, I'm sorry. Better to call, right? You want to make sure that all those are yours. And just like a debit card, a credit card, it's just numbers, right? You drop it on the floor by accident, someone walks by, takes a picture of it, or someone, you know, kind of writes down the numbers and puts it back in your wallet. They can order stuff online. So you want to keep these things close to you. You don't want to carry it around if you have no intention of using it. You know, if it's purely your emergency card, maybe keep it in the car, you know, keep it in the glove compartment, or keep it in the, you know, inside of a purse that you don't usually use. But you don't necessarily need to carry it all the time if you're not going to use it, because you want to make sure it doesn't have any identity theft. Oh, we're going, that's right. So again, just mentioning the MSGCU Visa Classic card encourages you to start early and start smart, in the sense that your credit, and we're going to talk more about that next week, your credit report, your credit score is based on your financial behavior, your financial responsibility. So the earlier you understand the basics of a credit card with a $300 limit, before you have the option of, spending a lot more money, before it's being recorded, you need time to literally just practice self-control, having that credit card and not using it. You can always tell yourself this is for emergencies. This is just for emergencies. But I mean, we know ourselves. What's an emergency? Is this sale an emergency? Maybe. So before you turn 18, before you jump out into living independently, learn about this, practice, ask about interest rates, have a credit card, and just put your $10 gym membership monthly on it and pay the full balance of $10 at the end of every month. What does that do? It's establishing positive habits. You're not paying debt, you're not paying interest, and you're making yourself look better for when it starts tracking, when you need to borrow again, and someone can look back and say, wow, look at this responsible behavior you had. But I do encourage comparison shopping. Of course, I'm partial to MSGCU, but I encourage you. Credit unions especially will generally have better interest rates than banks, but I encourage you to really get out there, compare what you get offered in the mail with what your own financial institution will offer you, with what maybe a competing financial institution. Were there any questions, any other questions about credit cards?
I haven't seen any, but I thought of a potential good one to ask you, I think. So for a young person, for a teenager or a young adult, there are obviously it varies in rates depending on who you get the card through. What would you say they should be trying to find as a fixed or variable rate for their card?
You mean like what number specifically?
Yeah, like what range should they be looking in exactly?
I mean, under 20%, definitely. I would say under 20%. Over time, 12%, 9%, as you get older and have more experience and a lot more credit to speak of. But certainly a fixed rate is going to be huge, because that it can't go higher than 20. It can't go higher than whatever it is. Mm-hmm. But yeah, I would say 19 is probably the highest that's acceptable, I guess, if that's the right word. And there's different kinds. There's, college cards or student cards or, student rewards cards. So they may sound like they're made for you, but it's just called a student card. There's nothing different about it. Or maybe it does have a benefit to, cheaper, no fees for this if you use it on campus, so you do want to look into all the details.
Yeah, it's important to find out because they will be marketing to you. I do remember getting all of those cards in the mail during my early 20s, honestly. I think was when they were sending me so many cards in the mail that I was pre-approved for.
Yep. And I'm going to guess, what did your first credit card look like? What did it look like on the outside?
I honestly can say, I didn't have my first credit card until I was 26, and I do still have it, so I could just show it, but...
No, I was just thinking that it's such a young person of having them look cool. Mine was leopard print. I always say that the reason I got that credit card was because I thought it looked cool. Who doesn't want a leopard print credit card? And that's exactly the wrong reason to sign up for that one.
I feel like with my first credit card, I was always turning down those offers and didn't really accept one until, at least I think I was around 26 when I accepted it. I was like, you know what, that seems
Yeah.
like it might be a good one. I need to start building credit outside of just paying back loans, which is how my credit was mainly built up before. So,
Right. That's a great point. You want to be cautious, but you don't want to avoid credit altogether. If you would have avoided credit cards altogether, you wouldn't have any of that positive, history to show for it.
but yeah, no, not seeing any questions from our audience. We do have one person on with us if they'd like to ask anything. Give them a second here. Let's see. Yeah, still nothing on the Facebook page either. So that looks like that might be it for today then. So we will return next Tuesday at 5:30 again. And the next one is going to be focused on building and boosting your credit.
All right. You got the debit account. Now you got the credit card. Now we're going to get some loans.
Yep. Next week we'll be trying to actually boost up that credit. So join us then.
All right. Have
Thanks
a
for
great
coming.
evening, everyone.
Yep. Bye.